Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.17, which is down about 2 basis points from last week's 6.19. However, that's not the whole story, as we had the FOMC press conference, and that stirred things up just a little bit. We're going to get into all of that in the main segment, so stick around. So here we have the U.S. 10-year, and like I said, things have gotten a little less than ideal, I would say, but still not bad. Now, the 30-year fix was sitting at a 6.17. I do think that is probably going to rise a little bit in the next week or so. As we can see, the 10-year was below 4%. And for, Wednesday, which is FOMC, it climbed a good bit. From about 3.977 all the way up to 4.072. Yeah. Climbed a little bit as of Thursday, October 30th. And the reason for that is what was going on during the press conference. So, we had our rate cut, so the Fed funds rate was cut. So the federal funds rate was cut to 4% from the previous 4.25. Now, during the press conference, Jerome Powell said that the December rate cut is not definitive, and the market really didn't like that. As soon as Jerome Powell said that, the market started to tank, as well as the bond market. So let me pull this up, the Fed Watch tool. So if we go to probabilities, the December, I don't have what it was prior. I'm not sure what it was, but I believe this December 2025 was it was a little higher. And we also had rate cuts out to 2.7 to 3 into 2027. So really the market was expecting more rate cuts, and because Jerome Powell said it's not definitive, it depends on the data, they're going to be data driven, the market wasn't super happy about that, which caused the bond market to tick down, as we can see, which caused the 10-year to come up. So not great for the bond market. They were really wanting more rate cuts, of course. Now, one good thing that we did get from the press conference is Jerome Powell did say that starting in December, quantitative tightening is going to end and easing will be put in place. So that's good news. And the market, so the U.S. equity market, the stock market, did start to rally from that. It looks like the bond market really didn't pick up too much from that. But I wasn't really expecting rates to get too much lower anyway. So I think that we're probably in a place where the 10-year isn't going to climb too much higher. And we might get it back to around this 4% area, but I'm really not expecting too much lower than that. At least until we get more rate cuts for sure. Maybe into late 2026 or early 2027, we might see the 10-year come down even further, which would be when mortgage interest rates would come down. Now, that is just my prediction. There's so much time in between now and then, and I'm not telling anyone to just wait for the rates to come down. If you're doing that and you could be saving money, or you could be in a home right now, I don't believe that makes great sense. So yeah, but moving on. So let's see. So FOMC was really the big deal, big ticket item this week. That was Wednesday. Don't really have much left for the rest of the week. Let me see. I thought that we had some other data come out, but it's okay. Specifically about refinancing and purchases, but not that I can see. Let's see next week. So looks like we will have manufacturing PMI next week on Monday. So we'll get to see if manufacturing is stepping up or if it is still contracting. Previously, it was 49.1. Anything below 50 is a contraction. Anything above 50 is an expansion. Let's see. I don't know what this loan officer survey is, so let's look at it together. Release quarterly survey of large domestic banks, which asks response about changes in the standards in terms of the bank's lending and the state of business and household demand for loans. This is tentative, but if this comes out, that'll be interesting for us to look at. So I've never seen that before. It's quarterly, so we will take a look. Government is still shut down, so any labor data we will not get until the government picks back up and opens up. And when it does, that flood of data will be crucial for us to look at. It's really going to impact the market pretty heavily. That is, if the numbers are different than what's expected, which I don't know if that's just because it's tentative, but I would imagine there's a forecast whenever this is going to be opened up. They just don't have one right now. So let's see. Next week, we also have services PMI. It looks like we do have ADP non-farm employment change. So that'll be some labor data to look at. Anything that's tentative that is due to government shutdown. While we won't be able to see that, I believe. I'm pretty sure that's the case. So we will have some data that we can look at. Yeah, so that's really all that we have for this week. Like I said, 30-year fix 6.17 down from 6.19. I expect this to come up a little bit, though, probably next week. So, yeah, this was today, 6.17 today. So next week, I would imagine it's a little bit higher. And again, these are the probabilities. So this is something to keep an eye out for. We do want to see if there are any shifts in the expectations of rate cuts because that will really impact the U.S. 10-year. And other than that, we hope that everyone that celebrates Halloween has a happy Halloween. And if anyone has any questions about purchases, refinancing, anything like that, give us a call at 877-TEAM-MBL or visit us at mortgagesbylynda.com. Have a great week. Bye.